Hi, welcome back. It's so much more fun talking about your winners than your losers, right? Because you can celebrate how well you picked the stock, and often, even though it might have been pure luck, you can claim that it was your skill that led you to success. But it is actually more instructive, more valuable to talk about your losers. And I'd like to talk about one of the stocks that's lost me money over the last 6 months, and the stock is Valeant. The reason I want to explore the stock is not so much because I want to pick at old scabs, but because there's both learning involved, because you can look at your valuation and say, what did I miss? And also a judgment you got to make today as to whether you want to continue to hold on to the stock. So let me take you back to November of 2015, which is when I first valued the stock on my blog. It was after a dizzying fall from grace. Valeant was one of the most widely held stocks among value investors, a stock that was a huge success story between 2010 and October of 2015. In fact, in October of 2015, the stock was trading close to its all-time high of $180 per share. Between early October, and the middle of November of 2015, the stock lost a big chunk of its value, almost 60% of its value. And in fact, when I valued in November of 2015, the stock was at 80. A lot of value investors felt that the market had overdone it and that this was a good time to jump in. So I decided to explore investing in the stock. Now, let's face it, a lot of bad things had happened to Valeant in October and November, including a breakdown of their acquisition process. There were accounting questions, there were legal questions, there were managerial questions, lots of big questions floating around. And in my first valuation of Valeant, I brought those questions to play and I valued the company at about $72 per share. In fact, even with a few changes put in, I cut to the mid-70s, $75 per share. And my conclusion in November of 2015 was that Valeant's old business model was broken, that they could not go back to their old way of doing business. You're saying, what was that old way of doing business? They grew through acquisitions and often used synergy and increasing prices on the drugs they acquired through acquisitions to make a lot of money. And because of the scandals they'd gone through, I made the assumption that they could not go back to their old ways. They had to become a more established pharmaceutical company, which means you could invest and grow through R&D. And based on that assumption is how I came up with the mid-70s. So my conclusion in November of 2015 was big drop in the price, but it's merited. I will not buy the stock because it doesn't look cheap to me. Now, between November of 2015 and May of 2016, the stock continued to drop from 80 to 70 to 50 down to about 33. And in fact, by the time I actually did the valuation in May of 2016, the stock was at $27 per share. Now I decided to revisit the valuation and look at what's happened between November and May. And here's what had happened. There'd been a complete vacuum. The company had stopped releasing financial statements because it couldn't get its books in order. Not good news. Its top managers, not just left, but they left in disgrace. In fact, they'd given testimony in front of Congress, which had shredded the public relations image for the company. So in other words, not only was Valeant now a pharmaceutical company, it wasn't even a very good one. In fact, I did 3 valuations of Valeant in May of 2016. I first valued Valeant as the star, pre-October 2015, the pathway they had. Then I valued it as a typical pharmaceutical company, somewhere in the middle, a cash cow, which is what the November of 2015 valuation was. And then I valued it as a dog. Dog in what sense? I assumed that revenue growth at Valeant would be well below that of typical pharmaceutical companies, closer to 3% than to 5 or 10%. I also assumed that margins would drop, partly because they would come under pricing pressure because of all the scandals they faced, and partly because they'd been playing some accounting games. So they'd moved expenses into the restructuring acquisition category, and they were going to come back as operating expenses. In fact, the operating margin I assumed was about 40.39%. And with that assumption of operating margin, and I capitalized R&D, I did all the things I do with typical pharmaceutical companies, I came up with a value of about $44 per share. Now remember, the stock was trading at 27. I accepted the fact there were lots of risks swirling around the company, but I chose to buy the stock at 27. Now, if you've been following the stock, you know that the last few months since I bought the stock have not been good ones. There was a brief period in August and September the stock went up just above 30, but it never got close to 44. And in fact, in last week when Valeant reported its most recent earnings report, and it was actually on the day of the election, on November 9th, the day after the earnings report came out, the stock opened at about $14 per share. That's a pretty substantial drop from even the 27 that I bought it at. Forget about the $80 in November of 2015 or the 180 in October of 2015. So now I'm faced with a challenge. I bought the stock at 27. I'd lost almost half my money. It is, as I said, the biggest loser in my portfolio. And the question is, what do I do now? Now, I can't reverse the old decision. I mean, obviously, if I had a chance, I'd go back and not do it, but that's not a choice you have in investing. And the question is, what do I do now? And to answer that question, I had to take a closer look at that earnings report from November of 2016 to see how much my value would have shifted. You're saying, why would you care? Because let's face it, the value's dropped to 22. Even though I bought at 27, because the stock is at 14 right now, the fact that I bought at 27 is irrelevant at this point. I cannot make back old money. That's the sunk cost fallacy that leads us to do bad things. I have to value the company as of right now. If the value is 18, 19, or 20, you know what? At $14, I'm going to hold the stock, maybe if I have the courage, even buy the stock. So I took a closer look at the most recent earnings report, and it doesn't contain good news, right? The revenues were down. In fact, in the 9 months of 2016, the first 3 quarters, revenues are down almost 5%. The cost of goods sold are up, the SG&A is up, the R&D is up. Operating income is down, but there was also a huge jump in amortization and impairment of finite life. You're saying, what is that amortization? It's actually a reflection of Valiant's past. Because it grew through acquisitions, it has a lot of amortization and impairment of assets it gets through acquisitions. And in fact, you add on to that the goodwill impairment. There's a pretty substantial amount of the drop in earnings that is due not to deterioration in operations. That's happening, but to past sins from the acquisitive days. So I wanted to take a look at how much of the earnings drop between 2015 and 2016 came from operating drop-off, revenues flattening out, margins going down, and how much came from acquisition-related charges. So here's what I did. I took the change in operating income from the first 3 quarters of 2016, think of those as the glory days of Valiant, to the first 3 quarters of 2015. So if you look at the two time periods, 2015, the glory period, 2016, the danger period, operating income has dropped by $2.077 billion. That's awful news, right? But then I looked at where that operating drop came from. About 317 million you can attribute to the 5% drop in revenues. In other words, if all that had happened was revenues had dropped by 5% and margins had stayed intact, their operating income would have dropped by about 300 million. That's about 15% of the drop. Their margins decreased as well. The gross margin dropped by about 3 to 4%. If the revenues had just stayed where they were and the margins had dropped by 3%, that would have been 192 million. Those two numbers put together is about what the 25% you get by adding the two together is approximately how much of the drop in operating income is coming from operations doing worse than they used to. 87% of the drop, though, comes from a change in amortization, that impairment of intangible assets and impairment of goodwill. This might be just my confirmation bias speaking, but a big chunk of the earnings drop in these 9 months can be traced to sins from periods past. Think of this as the hangover from the binge you went on acquisition. So this is it. You're saying, why would the company want to load up all this stuff in the first 9 months of 2016? Well, think about it. You've been hired as new management of the company and valued as new managers. You have an incentive to take every conceivable hit you can and put it into this year because it's going to make you look good next year. Because right now you're like a new president, a new prime minister coming in, and you're going to say the old guys, everything is is due to what they did. I have a feeling that a lot of the loading up you're seeing here is a reflection of the fact that the new management wants to kind of push all the costs into the past so that they can claim that any improvement that comes from their doing. That's human nature. I'm okay with that. But I have to be cognizant that while operating income dropped, a big chunk of that operating income is coming from these acquisition-related items. So what? Well, my story for Valiant originally was that it was a dog. It stays a dog, maybe a little mangier than it used to be. But my story has actually shifted very little. Perhaps I've underestimated how much of an adjustment period there would be, and maybe that drop in revenues is a reminder of that. So I have to be a little more careful about assuming they can go back to being even a regular dog. Maybe they'll have a couple of years before they get there. So here's what I did. I took the operating income from the last 12 months, the revenues, the gross income, the SG&A, up till the earnings before interest, taxes, depreciation, amortization, and R&D. And then I removed acquisition-related expenses. I said, well, those should be gone after you've taken them off the books. And I also re-estimated what the amortization would have to be, assuming that the acquisitions are now history and you're going to go back to being a traditional pharmaceutical company. With those changes put in, and putting aside enough money to create even that minimal 2.25% growth, I'm assuming in the long term, I come up with kind of a cleaned up operating income of 3.514 billion. That's going to become a base year number. That base year number is what I'm going to use to actually come up with my cash flows and my valuation. If you're wondering why the EBIT on this page is different from the cleaned up operating income from the previous page, it's because I capitalize R&D, which changes my operating margins. So my operating margin to start the game is about 41%. And for the next 2 years, and this is the learning that I've got from looking at the earnings report, I've actually left revenues flat. I think that it's going to take a lot longer to dig out of this hole than I assume. So I leave the revenues flat, leave the margins where they are. And after the second year, I start climbing out of the hole I've put them in. And as I climb out, my margins improve. My revenue growth picks up, but not to some astronomically high number. It actually picks up to just 3%. Stays around 3% for about 5 years and then drops back up down to a steady state growth rate of 2.25%. The big change, therefore, is I'm introducing an acquisition hangover, that 2-year period of flat revenues, into my valuation, which I did not have in May of 2016. It plays a big role in dropping my value to about $32.50. In fact, if I did not have that 2-year acquisition period, the adjustment period, my value would have been about 41, very close to my original valuation, because my core story, which was not an uplifting story in the first place, hasn't changed much. Now what? The value per share, at least based on my reading of this company, is $32.50. Stock is actually was trading at $15 on Wednesday when I did this valuation. I know that my original investment has lost me money, but selling at 15 would not just be just locking in my losses, but actually would be a bad decision to make, given that the value that I have is $32.50. Now, I'm not going to claim that I was able to make this decision easily, because to me, Valeant is a perfect test of that balance you need to maintain between what I call faith and feedback. Let me explain. When you're an investor who invests based on valuation, you need faith on 2 levels. You need faith in your own valuation so you can act on it. And you also need faith in markets coming back to your value. In other words, you need both faith in your valuation and in markets correcting their mistakes. Feedback, though, is learning from markets and learning from new information coming out that your original valuation might have been wrong. The reason I say it's a balance is if you have too much of one at the expense of the other, you're going to get into trouble. Faith without feedback is when you do a valuation and you get so stuck on the valuation that you shut off the feedback loop. You learn nothing from markets. You refuse to learn from new information. You stick with your valuation. You double down, triple down, quadruple down on your pathway to investment hell. Feedback without faith is just as dangerous. If you let feedback just come in and you kind of keep adjusting your valuation every time the market moves against you, you're not going to hold on to anything for very long. Your time horizon is going to be days and weeks, not years, and you can't make money as an investor either. I won't claim that I've found this balance, because I constantly struggle with this, and in the case of Valeant, to me, both effects kick in. There's that feedback effect. I am learning from the fact that I perhaps underestimated how easy it was going to be for Valeant to get back on some kind of steady state. I mean, the earnings reports for the last 2 quarters suggest to me that the climb back is going to be slower than expected, which is what caused me to lower the value. That said, though, the original reason I bought Valeant is because the price was lower than the value. I was able to buy at 27. My value is 44. If that faith still holds, and I believe it holds for me, then if I was willing to do that in May when the price was 27 and the value was 44, I should be even more willing to do it now, because it's even more undervalued. I don't do this very often, but I decided that in this case, the balance here led me to double down, hopefully double up if I'm talking about direction. I double my holdings of Valiant by buying at 15, and I'm going to sit back, and I'm not being naive here. I know there are dangers lurking, that the operating problems in the third quarter might be an indication of more problems to come, more declining revenues, lower margins in the future. I'm also well aware of the fact that recently there was a Valiant executive and a Philidor executive, the original scandal that got them into trouble, who were indicted. And they might very well drag Valiant back into a legal mess, which could cost them even more. So this is not an investment that is close to risk-free. But there is a place in my portfolio for investments like Valiant. So even though I haven't made money, in fact, I've lost a significant amount of money on the stock, I'm not willing to write it off as an investment yet. So I'm sure you will keep me posted, and if I'm wrong and the stock goes to 10, I'm sure some of you will email me to remind me of the mistake I made. But I'm okay with that. I mean, I invest knowing fully well that making mistakes is part of the game. And this is an investment where I have, in a sense, hopefully admitted my original mistake, but that doesn't make it a bad investment today. Thank you very much for listening.